Pfizer is down 37% year to date, trading at a 52-week low. But is it a buy now? Well, spoiler alert, the institutions think it is, having bought a tremendous amount of the shares. And we're going to run through all of that in today's episode. We're going to look at the historical performance of Pfizer Inc. We're going to jump into their income statements, looking at their top line revenue growth year on year, as well as their net income bottom line growth. We're going to look at the balance sheet, have a quick health check, their total cash versus total debt. We're also going to look at their competitors, how they have performed total return year to date, as well as over the last 5 years. And as I mentioned, we are going to see what are the institutions doing. Are they buying or are they selling? This is going to lead us nicely into that all-important dividend safety score and finding out some very important financial and dividend metrics for Pfizer that you need to understand before investing. And as always, we will run it through our stock valuation model, getting to our intrinsic value, calculating our acceptable buy price given our investor margin of safety. Now, as I mentioned, it has been hammered this year, significantly underperforming the S&P 500, which is up around 15%. In comparison, Pfizer hammered down to 37% year-to-date return at the 52-week low, and as we can see, now offering a yield of over 5%. Is it too good to be true for a company like Pfizer with this yield? And as we can see, the PE forward-looking is now below 10. So in terms of investor return, for those that have held over the last 10 years, you would have seen a return of around 11%. Now, even though this doesn't include those dividends reinvested, that is a shockingly poor return on any investment over the last 10 years, especially when you consider that doesn't even keep up with inflation, which we will touch upon shortly. Now, in terms of the business, how has it performed in terms of the top line growth year on year? Revenue, what do we look for? Well, 3 to 7% as a minimum year on year growth. December 2018, 40.8 billion on the top line. 5 years later, their most recent annual report, 100.3 billion. So a very, very large increase over the large period. And on a more granular level, what we can see from 2018 to 2020, in fact, the top line was essentially flat. And then we can see, and you can argue, especially due to COVID and the amount of money that Pfizer made, December 2020 to 21, it doubled their top line before increasing again by a significant amount in 2022. So it'll be interesting to see how essentially the December 23 annual report will be in terms of that top line growth, if they can continue to increase as what we've seen over the last few years. And we will shortly look at essentially the last 10 years percentage-wise too. Bottom line, how does that compare? Well, 11 billion of net income in 2018, almost 3 times as much 5 years later at 31 billion. So that bottom line growth essentially mirroring the top line revenue growth as well. What we can see though, however, is 2018 to 2019, we see a nice increase on the bottom line before it drops and then it picks up again. So some small inconsistencies, but a very strong performance nonetheless. Now, in terms of the balance sheet and a quick health review, so how have they performed cash versus total debt is what we like to see. So we can see December 2018, they reported 19 billion sitting on the balance sheet in cash and short-term investments. Latest quarterly report from a few weeks ago, more than double that at 45 billion. So they are sitting on a significant amount of cash. And one thing to understand with Pfizer, what they're currently doing is they're acquiring a lot of businesses to essentially grow their top line. So it will be interesting to see how profitable those businesses that Pfizer have acquired will be for the company. So top line, well, essentially the cash growth, let's see how that compares directionally and numerically to the total debt. So total debt around 42 billion sitting in December 2018. Latest quarterly report around 66 billion. So essentially their total debt is also increasing in line with that cash. Not a real worry given how fast their cash is increasing, but it is something we can touch upon when looking at our financial metrics. Now, in terms of the comparison total return for essentially their competitors in the pharmaceuticals industry, we have AstraZeneca, we have Bristol Myers, Merck & Co, and a few others you may or may not have heard of. So total return, how do they compare? Well, year to date, as we can see, Pfizer has been the worst performing at 35% negative growth. But as I always say, Past performance is not necessarily indicative of the future, but it is always good just to see how a company has performed. And what we're trying to look at is essentially, is this a very cheap price for Pfizer company? And can we also expect to see our yield on cost grow in double digits? Now, in terms of the last 5 years total return, as we can see, Pfizer has also been the worst performing, and in fact, the only competitor to have a negative growth, with all the other ones having very strong growth. AstraZeneca over 100% and Merck & Co around 83%. So they haven't been performing that well. So how does that compare to what the institutions are doing? Well, straight away, 68% of institutional ownership in Pfizer. And one thing we want to look at is, have they been buying more or selling more shares over the last 12 months? So the last 12 months, institutions sold around 10.5 billion worth of shares in the company. Now, interestingly, look at this. They have been buying 97 billion worth of shares, which far outweighs the total outflows. So this is one of the companies that we have reviewed on the channel where the institutions are buying in the masses. And as we can see here, Q2 of 2023, 74 billion worth of shares have been bought. Now, just because institutions are buying shares of Pfizer, it doesn't necessarily mean that we need to as well to follow them, but it's good to see whether or not, based on our analysis, we believe Pfizer is a buy now. Dividend safety score straight away 75, making it safe. Market cap 181 billion, making it a mega cap company. Now, for those that believe we're heading into a recession, here are some recession metrics. Last recession, 07-09, they in fact cut the dividend. Negative 6% sales during 07-09, but bear in mind this was the average growth, or in fact above the average growth of companies in the S&P 500 during 07-09, where it was in fact negative. And again, we can see, whilst it did have negative 45% return in the recession period, which is very poor, it did beat the S&P 500, which was down negative 55%. So just a few things to bear in mind for those who believe a recession is looming. So they have been paying dividends and increasing ones over the last 12 years. The latest increase, 2.5% in December 2022. Very poor, but we are expecting a dividend due or an increase over the next few months. So let's see what we receive. Last 5 years, 5% dividend compounded annually on average, and last 20 years, 6%. Now, what I say, and this is more for those newer viewers, is you want to be getting a minimum of 4% on your dividends, salary, or other income producing assets, because the US inflation rate over the last 40 years did increase by 4%. So if you're getting less, you are in fact taking a pay cut and losing your purchasing power. Now, based on dividend yield theory, which states a company is undervalued when the current yield sits above the 5-year average, 5.11 versus 3.78, we see our first sign of undervaluation. However, as always, we never look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. Likewise, 10.9 versus 12.1, again, another sign of undervaluation with the forward P below the 5-year average. And as we can see, it is below the sector P at 10.9 versus the healthcare of 16.6. Now, as I mentioned, is essentially right there at the 52-week low, but bear in mind, 52-week low is not a signal for undervaluation. Likewise, 52-week high is not a signal for overvaluation. Regular viewers, you know we ignore the earnings payout metrics. It is there for investors that do like to analyze this. We tend to focus our attention on the free cash flow. The reason for this, earnings is susceptible to manipulation by management through their accounting. And if you've seen other videos, we do look at some examples as to why this is. So free cash flow below 60% is what I personally like to see. It means management have the ability, in my opinion, to increase those dividends by double digits. For the large part, it has in fact been below 60%, 21 and 22, even below 40%. 2023 is expected to be 50%, which is still below that threshold I look for, so very positive, and gives me faith so far that that dividend is safe. Again, earnings per share metrics data is there for investors that want to look at that, but let's focus on the free cash flow, 238 in 2013, 464 in 2022, essentially nearly doubled the free cash flow over the last 10 years. 2023 is expected to come down, but bear in mind, up to the COVID period, it was essentially relatively flat. So this is one of the reasons, in my opinion, why Pfizer are essentially looking to grow through acquisitions rather than organically. Now, in terms of the sales growth, again, 3 to 7% is what we look for. And as I mentioned, the US inflation rate, if they're not hitting at least 4% annually, then they are in fact, in real terms, decreasing that sales. So we can see they haven't had the best of growth up to COVID, up to that 2022. 51 billion to around 41 billion. So in fact, it was decreasing. COVID then saw essentially their revenues double and increase again. So it will be interesting to see how that 2023 figure looks. But essentially, we are expecting those acquisitions at some point over the next year or two to show how well they are performing. Shares outstanding, yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets. 6.9 billion in 2013, 5.73 in 2022. We can see at some point they did a nice share buyback, but other than that, they do very, very small amounts. Nothing really to note there. Now, ROIC, return on invested capital, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. Plus 10% is personally what I look for. It gives me faith management are able to effectively allocate their capital. And we can see for the large part, it has been above that. 21 and 22, some stellar years for Pfizer, well above that. So far, I do have confidence in management. Operating margin and free cash flow margin, very, very strong. Even that pre those COVID results, above 12%. Alongside that free cash flow margin, very, very strong and consistent, which is what we love to see. Now, net debt to earnings before interest, tax, depreciation, amortization, one of the most important metrics. In my opinion, it basically shows the number of years it takes the company to pay off all of their debt net of cash on hand, 3 being our maximum we'd ideally like to see. 2021, 2022, below 1, and 2023 expected to be 0.87, still well below that 3. Doesn't really worry me, especially when we did take a look at the balance sheet review with their cash increasing significantly, probably in line with their total debt. On the right, purely showing the percentage of the company's financing from debt as opposed to equity. As always, if you do enjoy the content, value is being provided, do smash the like button, do hit the subscribe and bell button if you want to be continually notified of these videos as they drop. And if you want to grab a copy of the valuation model to run your own companies through to get your own intrinsic value acceptable by price, then do click on the pinned comment below. Now, jumping straight into Graham's valuation, the first formula that we're going to be going through. We have the stock ticker Pfizer, PFE, earnings per share. Now, growth rate analysts are expecting this to decrease, hence the -2, with that current yield on AAA corporate bonds at 5.4, giving an intrinsic value of $15. Now, when we take a look at that, that is significantly below the current trading price, below the 52-week low, showing signs of massive overvaluation in the current market. But do remember, we never look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then have multiples valuation model companies in a similar sector and size, AstraZeneca, Bristol Myers and Amgen. We have the stock price, earnings per share, PE multiple. We multiply the average by the earnings per share of Pfizer to get a stock price of $85. Now, when we take a look at that, that is some significant undervaluation in the market and above that 52-week high, showing strong signs of a buy right now. We then move on to the third model, the dividend discount model, where we have the growth rate of the yearly dividends. Last few years, fairly poor, below that 4% inflation rate. Again, I would like to see a minimum at least of 4% in their increase in December, especially given that yield is currently around 5%. So average growth rate, 3.83. Forward looking, I've gone essentially in line with the average. Again, if you do want to go for a higher or lower percent, depending on essentially your judgments, do grab a copy of the model to play around. This gives a DDM price of $40. As we can see, some nice upside to the current trading price at just over 20%, but within that 52-week range, again showing signs of undervaluation in the current market. We then move on to the fourth and final model, the DCF model, where we have our free cash flows year on year. Average growth rate per analyst estimates, well, average is 12%, analysts estimating a -4%, so a decrease year on year on those free cash flows. With a discount rate of 8%, we get the present value of future free cash flows and terminal value. When we add them together with the cash, subtract total debt, we arrive at the equity value. Divide that by the shares outstanding gives a DCF price of $51. As we can see, again, some strong upside to the current trading price, slightly lower than the 52-week high, but again, showing signs of undervaluation in the current market. As always, if you are enjoying the content, it really helps the channel if you just smash that like button and do subscribe and hit the bell if you want to join this lovely community. So the intrinsic value is essentially the average of the 4 models that we have just run through. And typically for a margin of safety, what I'd advise is 10% if you believe it has a strong financial metrics, strong or essentially wide moat and good forward-looking data. For Pfizer, I would say a higher margin of safety. So those looking at 15%, it would still be a buy up to $41. Those looking at 20%, it would still be a buy up to $38. 25%, $36. 30%, $33.49, and 35% you would be looking at a buy at $31. So essentially what we're saying with the estimates and judgments we've run through today, if you were to pick up these shares at up to $33.49, you would be locking in a 30% margin of safety. Now, Wall Street are forecasting some strong upside to the current trading price, slightly lower than our intrinsic value at $44.45. As always, if you do want to grab a copy of the model to get your own intrinsic value of companies in your own portfolio, or even if you want to run through Pfizer again, do click on the pinned comment below, grab a copy. As always, let me know your thoughts in the comments below. Are you looking to add Pfizer? Are you looking to sell? Or are you purely on the sidelines speculating? And if you want to join us in the Patreon where we are talking all things finance, do click on the pinned comment below and click on that Patreon link. As always, have a great day. Catch you on the next episode and take care.